if you push rates up from any more from here, you will very quickly bring on a financial crisis much worse than Lehman. They need a much higher inflation target because the only way to get out of that kind of debt hole is if you keep inflation above or trending above interest rates. And that's how you monetize the debt. And so it's a slow default, it's a manageable default, but it's really the only way out of this kind of colossal debt hole. And when I talk to, the most sophisticated investors around the world, billionaire clients of ours, they think, yeah, that's the path where they open the door toward a 3% target.
Hello, I'm Michelle Makori. Thank you for joining us. While the Fed continues to maintain that it needs inflation to come down to 2%, former U.S. Treasury Secretary Larry Summers believes that the Fed should drop its 2% inflation goal. Speaking at the Hoover Institution last week, Summers warned that keeping that target would force the U.S. economy into a fairly serious recession. And some Democratic senators have also been questioning the 2% target, putting out the idea that 3% should be the new standard rate. Well, my next guest says that he expects inflation at above 3% to soon be normalized. In fact, he's warning of a new era of persistent inflation and says we are at the very beginning of a seismic shift in the performance of financial assets and that the economic world as we know it and the rules that govern it is over. He warns that we are headed not only into an era of persistent inflation, but also an escalation in global conflict, a multipolar world teaming up against the U.S., a weakening dollar, a series of sovereign debt crises, and a thundering of capital out of financial assets and into hard assets. Larry McDonald is New York Times bestselling author of A Colossal Failure of Common Sense and his new bestseller, How to Listen When Markets Speak. Larry is also the founder and editor at the Bear Traps Report, which is an independent research institutional platform. And previously, Larry headed the U.S. macro strategy team at SocGen and was a special advisor to the Financial Crisis Inquiry Commission, which was appointed to investigate the causes of the 2008 financial crisis. Larry, welcome to Kitco. Very good to have you with us.
Thank you, Michelle. It's a pleasure. I've always appreciated the Kitco audience, so thank you.
Well, I'm sure they will appreciate you. And as I said, that's just a brief background. And I must say, Larry, I read your book thoroughly. I really enjoyed it. I liked how it gives a recap of historical events, explaining how we got here. And I also like how you disperse interviews and encounters with financial giants along the way and add their perspectives and point to what that means for us in the future. So we're going to start off with a zoom into the macro outlook that you have, a big picture outlook into your book, and then bring it into a more near-term focus. Now, let's start off with, I guess, one of the big lines in your book when you say the world is about to witness the most epic migration of capital in the history of financial markets. Break that down for us.
Yeah, the opportunities are incredible ahead of us because essentially we work with institutional investors in over 20 countries. And over the last decade, there's no I in team. And this book, When Markets Speak, is about democratizing information. And I've been gathering ideas, working with mentors, and kind of developing this thesis with some of the, most incredible investors around the world. And it all comes down to very simple. When you have about a $35 trillion debt problem, there's two ways out of that. There's a debt jubilee, which we've seen experience in, say, Argentina, where we've kind of defaulted over and over again, a reset. Or in other civilizations, you just print your way out. And I think the only way out here is to have, and they're very careful with you brilliantly just laid it out. They're very careful around the messaging. They're going to do this very slowly in terms of how they change the message, but they need a much higher inflation target because the only way to get out of that kind of debt hole is if you keep inflation above or trending above interest rates. And that's how you monetize the debt. And so it's a slow default. It's a manageable default, but it's really the only way out of this kind of colossal debt hole.
Right. And of course, as I mentioned at the top, you paint a picture of the era that awaits us. But you say that so much of this hinges on inflation. And you write, and I'm quoting you here again, the following may be the most important sentence in this book. If inflation normalizes in the cycle at 3 to 4% instead of 1 to 2%, as in previous decades, trillions of dollars are misallocated across the investment asset ecosystem, as most portfolios are still massively overweight growth stocks. Usually during a time of recession, the prices of energy and oil drop dramatically due to lower demand, which acts as a major deflationary force. But going forward, the price of energy will likely stay relatively high even during recessions. And you point out how much of this is due to chronic underinvestment in the oil and gas industries in the US and Canada. So again, one of the biggest distinctions that you point out in the book is that we're now in a multipolar world versus a unipolar world, and that there's always a connection between geopolitics and inflation. So break down this idea, firstly, of how energy is so critical to where we are right now and why we would see a normalized 3% or higher inflation rate.
Well, think about the Lehman crisis. It was the fiscal and monetary response to Lehman, which was a big crisis, the great financial crisis. The fiscal and monetary response from the Fed was about $4 trillion. But the fiscal and monetary response to COVID, as well as the banking crisis last year, is about $16 trillion. And as you mentioned, now we've got two global conflicts today. So we've moved from a like it's called a unipolar world, which is where you have one superpower that dominates. Supply chains are very smooth. But if you have a multipolar world with more global conflicts, you need a 1968 to 1981 type portfolio, which is dramatically different. And because the Lehman crisis, because that was so deflationary over the last 15, 20 years, every investor just about watching us has been conditioned toward inflation normalization. So everybody's in kind of a deflation portfolio, which is, like you said, financial assets, which are stocks, growth stocks typically, and bonds. And so if you look at the capital, there's 21 trillion in the NASDAQ 100. The percentage of the S&P that's actually in oil and gas and metals is like 7%. In 1981, the S&P was 49% industrials, oil and gas, materials, and metals. 49%. Now that's way down near 12 or 13. So it's really a whole new reset of what you need for your portfolio for the next decade.
Right, and we'll get down into that portfolio allocation as we break this down further. But I just want to focus more on this whole idea of inflation and why are you so convinced that the Fed is not going to be able to hit its 2% target? I mean, Jerome Powell is trying to sound very convincing that is still his goal and that is still a top priority of his.
Well, that's the problem is with the $16 trillion fiscal and monetary response, they're trying to get through the election. What they're trying to do is the team Biden is basically making a big gamble. They know if they can keep the unemployment down through the election, they have a much better chance of winning. They're willing to deal with inflation, but what they don't want, and remember, this is roughly the same team that was in the White House in 2008. And they know that 2008 financial crisis and that spike in unemployment had a huge impact on the 2008 election. And so they're making a gamble, and that's why you've seen this about $1 trillion every 100 days of deficit spending. $1 trillion. Since 2020, the U.S. debt's up over, I think, close to 45% higher since 2020. That's with Biden and Trump. And so all of that fiscal and monetary juice is oozing around the world or oozing around the United States, and it makes it almost impossible for Powell to hike rates and stop inflation with that kind of backdrop.
So you're saying that, in fact, he should be talking about further rate hikes rather than what the markets are expecting and anticipating and hoping for, and that's rate cuts. You're thinking that the right move for Powell in terms of inflation taming is further rate hikes, not just maintaining higher for longer.
In theory, that's what we should do if we were sitting like in a chalkboard, we're looking at a university chalkboard, he should raise rates another 150 basis points. The problem is when you suppress the cost of capital for over a decade at a fake, irresponsible, grossly disgusting level of, you basically created all of these commercial real estate loans, all of these auto loans, all this financing for the US government debt, all the commercial real estate. It's basically all these bonds are sitting out there 1%, 2%, 3% coupons. And so if you push rates up from here, from any more from here, you will very quickly bring on a financial crisis much worse than Lehman. If you look at what happened in October of 22, Bank of America stock, when the 10-year bond was up close to 5.5%, it was approaching 6%. Bank of America equity was down 50% because these banks are long tons of commercial real estate, tons of mortgages, and tons of treasuries. And though the interest rate risk and the credit risk on those assets is so spectacular because the Fed suppressed rates near zero for so long. So as interest rates go up, bond prices go down, and that creates a credit crisis probably 2 to 3 times bigger than Lehman Brothers if they were to hike rates aggressively from here.
Right, and I'll point out to our viewers that you are one of the top traders in Lehman Brothers, and one of your books discusses in detail the collapse of Lehman. So you certainly know what you're talking about when you mention Lehman Brothers and the 2008 financial crisis. Again, before we go back into the big picture, let's focus on the near term. And okay, a rate hike is what the Fed should be doing to tame inflation. It's not what it's going to be doing. In terms of a cut, though, can the Fed cut before the elections without it looking like it's being political, without it looking that it's interfering?
Exactly. So that's why in December, Powell, strategically pivoted because he was hoping that they could cut by June, March, April, May, June. That would be ideal. But then, here it is. The beast in the market, the moment they soften the path, the dollar weakened, commodities ripped, gasoline prices were up 40% very quickly. And once again, we're in that multipolar world with the stress in the Middle East. That really supported much higher gasoline and oil prices. And then now he's in a situation where he's having a very difficult time to cut rates, even though politically he probably should do it in June. And like you said, not in September, October, right ahead of the election.
So do you expect a cut in September? When do you expect a cut for this cycle?
I think we're going to get a cut before the election for sure, because if you look at the way the regional banks are performing, you look at the way, say, some of the life insurance companies that are exposed to commercial real estate, like Lincoln Financial, there's a lot of credit risk out there that the Fed knows about. And the bottom part of the consumers are getting killed, like the bottom 60%. Just look at Expedia versus, say, Delta Airlines. It's talking about the largest divergence we've seen in decades. And don't forget, Expedia, they sell, that's kind of like your travel agent to the middle-class American. That stock's in flames, whereas Delta Airlines and some of the airlines that cater toward business travel, those stocks are doing pretty well. So look at Starbucks. Look at the weakness in some of the restaurants like McDonald's. We're at the point where you're at the bone. Inflation and interest rates are so high, the companies can't pass along the costs anymore. So the political pressure to get rates lower is so off the charts high, plus all the commercial real estate credit risk that's brewing every single day. So yeah, I think they definitely cut before the election.
But then, Larry, it still doesn't even make a big difference considering rates are where we are. And as you point out in the book, we got so used to ZIRP, practically zero interest rates for so long, that considering we have rates so high, one cut of 25 basis points, even 50 basis points, sentiment-wise, it may cause some kind of market rally in equities potentially, but it doesn't really take that burden off the businesses that you just cited or off the consumers.
Right. And so what they want to do is, if you forecast, or if you kind of tip your hand, if you're a central banker and you tip your hand toward a softer path, the market will assume, far more than, say, 2 cuts, and you'll get some love there and some support. And that's essentially what already happened. Like, they tipped their hand toward a softer path in December. Financial conditions eased dramatically. But then that reaccelerates inflation very fast because of all that fiscal and monetary stimulus that's still out there. And so that's the problem. The moment they tip their hand, and this gets back to a really bullish scenario for hard assets, oil, gas, uranium. The setup is really incredibly bullish, and maybe, and even so for emerging markets.
Right. Your whole thesis is that we're going to have a major return to hard assets and commodities. I want to break that down, but let's first focus on this idea that you expect 3% plus to be normalized. I mean, do you expect a shift in messaging there? As I mentioned at the top, some Democratic senators, including Bradley Sherman, they were recently questioning the origin of this 2% target, pointing out that it started in New Zealand, saying, it's a bit arbitrary. Why do we even stick to that number? A goal that originated, 36 years ago in New Zealand. So there's already some pushback from Democrats saying, well, what's so bad about 3% anyway? Do you think that we're going to start to see a narrative spin on that soon?
Yes. And the place to do that, Michelle, would be Jackson Hole. What you start to do is you start circulating the white papers, and you start working with other central bankers around the world to pitch this in a group setting. And I think Jackson Hole will be the first time they formally start to introduce this, because once again, financial repression, if you have a $35 trillion debt hole, what you need to do is have interest rates below the rate of inflation. So interest rates here, and inflation here. And so that's a way that you can monetize the debt over time. And so eventually they get forced into some type of, say we go into any type of economic weakness, they'll get forced into, some type of yield curve control, keeping yields lower with inflation that's going, like you said, from 2 to 3, 4%. And that's where you really are starting to monetize the debt. You're wiping out the debt with inflation.
So interesting, Larry, you are speculating, forecasting that come Jackson Hole, the Fed and other central bankers will have a meeting and come forward with this new consensus and put it out there that blatantly that this is the new target, that there could be some sort of formal announcement or start to formalize that message out of Jackson Hole, not just with the Fed, but other central banks?
Well, they won't announce the target change on that day in August, but they definitely, I think, is a high. And remember, we work with hedge funds, mutual funds, and pension funds. And this book, When Markets Speak, it's all about kind of democratizing information. And when I talk to, the most sophisticated investors around the world, billionaire clients of ours, they think, that's the path where they open the door toward a 3% target through exploration. But once they do that, that's just walking 1 or 2 inches down that path will change asset prices dramatically.
Right. So let's explore that. What does a normalized 3 to 4%, and remember what the Fed says inflation is and what inflation really is, it's a whole other conversation anyway. But what does a normalized 3 to 4% mean? And we'll start off, with the assets that you expect to rally on that.
So when you move into the early stages of a commodity bull market in a sector, or just think of oil and gas in 2020, the first stage is the mothership, where people move into the commodity, then they move into large cap companies, say Exxon and Chevron. And then as the bull market matures, they move into smaller companies like your Hesses and your Marathons. And we saw the same thing with uranium. It was first Sprott ETFs that's actually the commodity. And then you move into the larger cap names like Chemico. And now we're starting to see real capital move into next gen and some of the smaller players. And we think around like gold. The gold bull market, everybody wants to be in the mothership. All the central banks are piling into gold. The next stage will be silver and platinum. And the gold-silver ratio, the way it's acting, it's pointing toward a very large outsized move in silver. You're at an 84, 85 handle on the gold-silver ratio in a typical commodity bull market that's really sustainable, as we experienced many times in the last 30 years. This ratio should be in the mid to low 60s or more. So we see a spectacular outperformance of silver versus gold. So you want to be long the SIL ETF, the SLV, your HECLAs, HL, and then on the most, one of the most sexy stories out there, I think, is platinum. Your gold to platinum ratio is screaming. Sell gold and buy platinum.
All right, a lot to unpack there, Larry, but some of the arguments for commodities linked to industrial use and therefore economic growth, right? I mean, we have to kind of separate gold because that's seen as an inflation hedge, a hedge against debasement and devaluation of currencies. You also discuss the demise of the dollar and the BRICS coming up with their own common currency in your book, and the general trend of de-dollarization. That's all been bullish for the gold trend as well as inflation. But when you talk about these other commodities that you expect to do better than gold, break down for us why they would do well in this environment. Do you expect economic growth? Because aren't these dependent largely on a robust economy in terms of demand and growth? And we are starting to see signs of stagflation, certainly here in the US. So what's the thesis as to why we're still going to see a commodity super cycle and demand for those commodities if we're sort of looking like we're seeing a general economic decline headed our way?
Okay, so you bring up some good points. So think of platinum. There's two stages to silver and say platinum in terms of when they get moving. One is just the rarity. I mean, all the gold ever mined in the history of humanity everybody knows this, you can fit it into an Olympic-sized swimming pool. All the platinum ever mined in the history of humanity, if you're in that same pool, would just go up to your ankles. And so the rarity of it's almost like Bitcoin in a way. You're so scarce in terms of the actual platinum that if you go into a kind of a stagflationary environment, capital will definitely move into the metal, even though there is an industrial component risk. The other side of it is once you start to get the rate cuts, you get a weaker dollar. That weaker dollar will really start supporting the global economy with the rate cuts. And then you get this, like you said, this economic afterburner with silver. Silver's now, everybody knows, it's a major component in solar panels. You got a big growth upside there. And that's one of the points we make in our book, When Markets Speak, is that we have this whole green initiative, all this, this massive amount of fiscal spending globally on the green revolution, and the metals necessary for this revolution and all of the commodities are in scarce supply because we've been through a long period of suppressing investment, and that's where just the scarcity of these strategic assets. And then you look at all of the cobalt and all of the copper and all of these strategic assets that Russia and China have oligopoly type power in places like uranium. And now we have our friends in Washington and Congress panicking, trying to create legislation because they know they're behind the eight ball here. And so all of this sets up for really a spectacular move in commodities, hard assets relative to financial assets.
Right, and you make the point in the book that cheap borrowing rates single-handedly created that great wave of exploration of oil in 2009, which was very beneficial to the U.S. We have arguably an administration that has been much more stringent on regulation for the domestic oil and gas sector, less drilling, less exploring, higher rates, making it more expensive. What does that mean? And I'm going to focus on oil for now. What does that mean for your outlook for oil then?
Well, think of like 2010 to 2014. If you look at the exploration of oil and gas and metals and mining and uranium, but if you look at all the exploration for the key commodities, especially oil and gas, if you went on that path from 2010 to 2014 and you extrapolated that path to today, we're essentially in a $3 trillion hole in terms of investments that we need for the planet in oil and gas, metals, materials, all the key aluminum, copper, uranium. And so we're in a $3 trillion investment hole. And that has a lot to do with, like you said, regulation, ESG, has a lot to do with the last commodity bear market. A lot of CFOs have burnt. And so they've been much more capital disciplined. And so all of this is like a perfect storm. But guess what? From 2014 to 2024, the global population, Michelle, is up 950 million people. So we have a planet Earth with over 10 years with 950 more people on it. There's a billion people in India. There's a billion people that don't have air conditioning. And so what we've done is we've exported 5 million jobs out of the United States. We've raised the standard of living, like the Rust Belt. Many parts of the United States, the manufacturing base has been decimated, but we've raised the standard of living all around the world in a beautiful way. The problem is, there's a price to pay for that. We're increasing the carbon consumption. If you're a young couple in India and you're now making 10, 20 times more than your great grandparents because you're working in a call center, the first thing you do is buy a moped. The second thing you do is go get an air conditioner. And so this is a colossal failure of judgment by the global central planners. And it's going to create an explosion, what we believe in the book, of demand from the developing world for these key commodities. And like I said, we are in a massive investment hole to supply, to reach that demand.
So do you have like an oil outlook for, I don't know, I guess the next 5 years out? Because the book looks at things in a much more long-term perspective, right? What is the timeline that you expect for this to start to be reflected in the markets?
Well, yes, the Strategic Petroleum Reserve is almost on empty. We've got a lot of politics around that. Like you said, we are in a multipolar world. And so, unless we have a really deep recession, like a Lehman type recession, we're looking at, the new range on oil. Your bottom is 55, 60 on Brent, but your upside is $150 over the next 5 years. So you've got much less downside risk and much higher potential prices. And then the big one is natural gas. We obviously have an excess supply of natural gas right now, but we have all of these electric vehicles, all of these data centers that are artificially intelligence driven. The terawatt hours in 2022 for these data centers for artificial intelligence was like 450. We see potentially 2,000 by 2028. So we see natural gas prices going from say $2 to potentially $8 by 2026, 27, 28, just because we've got this explosion in demand coming from the technology side and coming from emerging markets at the same time.
All right. So by 2028, that's just over 3 years out. That's a pretty near-term target, even though you're painting a much longer-term picture in the book.
So 2028.
And I'll get back to the other commodities as a little bit later on in the show, but I do want to focus now on where you see we are in terms of the general sort of equity climate, because we're talking about oil and there's all these sort of potential geopolitical escalators. Middle East tension is still very, very, very high, which of course would have another impact on oil with global supply chains in a multipolar world. We still have the Russia-Ukraine conflict, big question marks about what's going to happen with Russia and Ukraine still. And I want to bring up a point in the book, which I really enjoyed, as I said, that you weave in these anecdotes of you meeting with financial giants and the personal rapport that you have with them. And you bring up David Tepper, who's the billionaire founder of Appaloosa Management. You talk about your meeting with him and you ask him how he knows when to stay long or short in the general market. And I'm quoting the book again, and he writes, so you write, quoting him, "So the way I see it, if you have one or two things in the market that are concerning, and that could be anything from a rate hike to a dangerous earnings patch, maybe a small conflict in the Middle East, whatever it is, with just one or two of those, I keep my long positions on. But when that number gets higher than 4, I start cutting bait. That's when I shift from mostly long to adding to my shorts. That's how I stay out of trouble." That's you quoting David Tepper. "It's usually the best move to be long since the market goes up far more often than not. The best time to buy in is when the market bottoms. Of course, timing is everything." So Larry, by Tepper's approach, We have a few more risk factors on the table than should make us feel comfortable staying along. How do you take Tepper's approach by looking at the risk factors, and how do you now interpret that in terms of what you think it means for the general markets and taking a short or long position?
Well, in the last couple of weeks, we have a potential peace deal. That was, I think, the Egyptian deal, which Israel hasn't really acknowledged. So the market was comforted by that. And we did have a pretty big move down in oil so far for the last couple of weeks. But as we look forward, it's very clear that the Israel conflict in the Middle East with the Palestinian conflict and with Iran is not, I think by at least through the year, it's potentially going to get worse. Let's say by the summer, we're going to have a summer driving season with higher gas prices because as demand comes in, and then the election uncertainty is going to start to come in, and then once again, like I said before, commercial real estate. You've got 1.2 trillion of maturities in the next 12 months that are going to reset higher, and so that reset risk is developing, and it's out there, and it's what the institutions are looking at. The good news is right now, high yield spreads are still pretty tight, and that's telling you that the credit markets are pretty comfortable. But Tepper's point around these multiple factors that are going to be kind of a test for the market really start to pick up as we move into the summertime with the election, especially.
Right. I mean, we've got U.S. elections. I mean, the elections all around the world. I know you're in Panama now because you were monitoring the elections there, but we've got the U.S. elections, which are a huge question mark, considering it's an unprecedented election cycle, to put it mildly, considering what we're seeing. So elections, Russia-Ukraine war, Middle East crisis, Palestinian issue, Iranian issue, Russia-Ukraine. Some are saying that come November, that would probably be the ideal time. If China was ever going to move into Taiwan, this would be the time. So looking at those, Tepper risk factors, does that mean that you would start to short the market after the summer?
Well, the old sell in May and go away, it hasn't worked that well in recent years, but over the last 20 years, there are many years where that, works out pretty well. And it worked out very well in 2016, which was an election year. Because we had a rough patch, right in some August and September. And so, I think you want to be lightening up here. We've got a beautiful run in equities, raise some cash. You want to have some cash to take advantage of market weakness. And most importantly, you want to keep an eye on credit risk in the banks. So the way the banks are acting, like the KBW index or the KRE or the super regional banks, like the way Zions and Comerica are acting, or a U.S. Bancorp, they're dramatically underperforming the S&P 500. So there's like a divergence going on within the financial system that tells you that we have some pretty significant credit risk. That the problem is if you go higher for longer, if you do that, and they've kept rates up here for a long time now, since we stopped hiking, but they've kept rates up here. Every day rates are up here, you put more and more stress on the banks, and that's going to start to materialize towards September as well.
Sell in May and go away if we're looking at the broad equity markets, but there are some commodity-linked positions that you would advocate to stay in or sell in and use a downturn as a buying opportunity.
Yeah, I think that if you just look at the term premium is the trustworthiness on U.S. long-term debt. That term premium risk has been expanding, and so that's going to support commodities. And like I said, there's a number of commodities like natural gas, like platinum, silver, that are very, very cheap on a risk-reward basis. So you could be very, very much okay in commodities. And even commodity equities. I mean, every buy that we've had since 2020 with the Evergrande crisis, China property crisis, the China lockdowns, energy stocks have been a buy. And so we want to be in there, picking up energy names on any kind of pullback for sure.
So I want to focus a little bit on what you said about your concerns about the risk to the banking sector. What's your outlook there? You're saying that they're not going to be able to withhold these rates at the level that they are for much longer. What are you expecting to see?
Well, the larger banks have done okay, right? And so if you look at the XLF, in recent weeks, the XLF, which is the financial ETF, has been a very large, like one of the highest percentages above the 200-day moving average. So people have climbing into your Berkshires, your MasterCards, your Visas, your American Expresses. And so what happens as a storm approaches from off the shore, capital will flow into what they perceive safe parts of the financial stocks, because a lot of investors still need to own the financials. But the divergence between those financials and your regional banks and your super regional banks is just one of the largest we've seen in decades. And that tells you that there's this gnawing problem in the regional banks, as super regional, and these are not little banks. These are super regionals. The U.S. Bank Corp is I think the fifth or sixth largest bank in the United States. So if you look at the performance of these super regionals versus, say, American Express or Berkshire or MasterCard, Visa, the divergence is pretty crazy. And so that tells you that this consumer weakness and this commercial real estate weakness, if they keep rates up here, all of that refinancing for all those loans gets reset from 1%, 2%, 3% to 4%, 5%, 6%, 7%, 8%. And that creates a pretty sharp credit crisis later on in the year. So that's what's going to force the Fed to cut.
So do you see more consolidation than in the banking sector as these small regional banks collapse? Will they be, picked up by some of the bigger players as we saw in the last sort of banking crisis in March?
Yes, we just look at the amount of regional banks in the United States versus Canada. It's a crazy difference. And so we're going to have a massive M&A cycle where the larger banks just swallow up smaller and smaller banks. And if you look at every time rates go up, like 2-3 weeks ago, rates were a little bit higher than they are not now. We started to see really even more significant divergence in the regional banks. And so you just know that there's just another 50 basis points of interest rate risk up really starts to impair the banks. And then you start to see that divergence between the banks and the rest of the market very, very quickly.
So, Larry, I want to bring it from David Tepper to David Einhorn, which is another financial great that you quote in the book, and you discussed your meeting with him, David Einhorn of Greenlight Capital, who is also very long copper, very long gold. He is certainly in the same camp as you regarding commodities. But in the book, you used the conversation there to discuss the dangers of passive investing and of ETFs, exchange-traded funds, and why that could be very perilous for the markets with the amount of passive money in these ETFs. Break that down for us.
Well, Jack Bogle, the Vanguard founder, he meant well when he created index funds. But there's a point where the amount of capital that goes into passive becomes evil, because you're taking more and more capital, more and more investors, and the amount of eyeballs you need on companies really falls by the wayside. David Einhorn in our book talked about he's on these conference calls, and normally there would be hard-hitting questions over the last 20 years on senior management, but BlackRock, Vanguard, State Street, these passive index funds control so much of the S&P 500, so much of the NASDAQ, that there's just blind faith that's gone into index funds. Let me give you an example. So NVIDIA was, within the last 18 months, was 1% of the S&P. And now, magically, because of artificial intelligence and the stock going up, and because of passive inflows, It's almost 5% of the S&P 500, 5%. And you're just talking about a company that is obviously very volatile historically. The company's had many different moves into artificial intelligence, into meta chips, into crypto chips. And so you just have this like herd mentality where people pile in to index funds that puts more and more capital into fewer and fewer names. And then the indexing fund of like when companies come into the S&P 500, look at Uber. Uber came into the S&P 500 and ran up 40% as people are like gaming the system. It's really quite evil because people know there's 35 trillion, more than 35 trillion that's tied to passive index funds, right? So if you can try to figure out which companies are going to go into the S&P or into the NASDAQ, you front run that. Look at companies like Lululemon. Lululemon was up 40% as it went into the S&P. Like I said, Uber was up 40, 50, 60% as it went into the S&P. And then you look at Super Microcomputer, that was up 300% as it went into the S&P. And so that's where you get this real gaming system, and it gets to be quite evil relative to the way the markets worked historically.
And Larry, what's interesting with these ETFs, as David Einhorn points out in your book, is that it kind of negates the whole idea of the ETF in the first place. It distorts the whole concept. And you're right, quoting him, one of the main problems with passive funds is that they don't even fulfill their own logic anymore. It only makes sense if you have the philosophy that the market is smarter than I am, and I don't want to try outthink all of those thinking people. In other words, if I buy an index of stocks and they're weighted by market cap, I can be a price taker and I can therefore participate in the market without determining the price. But when such a high percentage of the trading and investing flows becomes passive, the passive funds shift from being the price takers to the price makers. And if you're the one making the price, you can no longer make the argument that the market is efficient and everybody else has already figured it out because you've just run over all of that analysis with a steamroller, which I think was quite a brilliant point that David brings up. And so I use that to talk about what is driving markets, because you say it's herd mentality, right? And it's sentiment driven. And if we now have this takeover of ETFs, does it even matter that the fundamentals of commodity equities are going to be the ones with the stronger fundamentals if the market sentiment and herd mentality doesn't catch on to that idea? Will that be at some point reflected in the equities linked to commodities if there isn't that ETF herd mentality market sentiment that goes along in that direction, regardless of whether the fundamentals do indeed merit it?
Yes, that is definitely something to worry about if you're a commodity investor. But just look at 2022. We had inflation spike, and it looked like we were into this new inflation regime at a much more sustainable level. And so we did see a lot of capital flow out of growth into value. And we saw a lot of the major, the Mag 7 and the big caps tech stocks suffered, pretty violently. And so that's one thing. And I think the other thing that's really telling is that long duration equities like software companies or ARC stocks, they're dramatically underperforming cash, the cash cows ETF, COWZ, or just large energy companies. So the spread between oil and gas value stocks and say long duration equities, which we talk about in the book, When Markets Speak, that spread is already dramatically widening. In other words, when you have a company like a software company that doesn't have much cash and that produces cash flows over 10 years, in a certain inflationary regime, the money will move out of those types of stocks over toward value, over toward commodities. The other important thing that we talk about in the book is that the oldest boomers now, Michelle, are 78 years old. So think of the baby boomers. They have 78 trillion of wealth, 78 trillion, and the oldest boomer is 78. So 10 years ago, the oldest boomer was 68. And so over time, there is a point where this passive really bonanza slash lottery ticket game of money flowing in and chasing, and that driving prices higher, higher, higher. Once the boomers start really starting to once bonds are attractive, if you're 75 years old and you've got a 5% 10-year bond, that's going to move money out of stocks and into bonds pretty fast. So that's another, pretty serious headwind for stocks is the bond yields today with the age of the boomers.
Yeah, that's an interesting point. Another interesting statistic that you point out in the book, that U.S. household wealth and allocation of investors' capital, and you cite Goldman Sachs saying that stocks have surged to nearly 40% of household financial assets in this decade. That's a significant increase compared to 28% in the 2010s, 18% in the 2000s, 33% in the 1990s, 17% in the 1980s, and 11% during the inflation-ridden 1970s. So 40% of household financial assets in equities. What does that mean if we do see this equity decline?
Yeah, it's really the growth of passive investing. It takes the brains, it takes the governor out of the market, and it creates higher prices bring out buyers. There's a line in the book, right? Higher prices bring out buyers, lower prices bring out sellers. Size opens eyes. It takes people a lifetime in finance to learn this basic principle, but those words are so important, because if you're an investor sitting at home right now, you want to use this momentum to raise cash and be there for a better opportunity, a better entry point. And you just don't want to get sucked in with the mad mob of the higher prices bring out buyers, because the lower prices will bring out sellers for sure.
Larry, I love this line, FOMO, fear of missing out, most deadly financial disease of the 21st century. I love that line verse because it's so accurate, right? Fear of missing out, the most deadly financial disease of the 21st century. And it's exactly, what you've just explained to us right now. I want to take it back to this very serious situation, though, of U.S. debt. And again, in the book, you argue that a sustained era of high interest rates will make the debt impossible to finance. And you also point that into the bigger picture again of the demise of the dollar. Again, in the long term, it's a topic we cover quite extensively here at Kitco, how we are seeing this trend of de-dollarization, how we are in a multipolar world, how we do have other countries opting to trade in their own currencies, opting to de-dollarize, potentially launching commodity-backed common currency. That's still in the works. Where do you see the dollar in terms of its life cycle?
So, if you think of like the Fed, the last 18 months, almost 20 months, they hiked rates aggressively from 0 to 5.5. But for the last 9 months or so, they've been using their vocal cords not hiking, to try to contain inflation. And what happens is, as you do that over time, each day, each week, each month, each hour, you're just using the vocal cords. The beast in the market gets the joke. And if interest on the debt is, if you claim you're going to go higher for longer, interest on the debt now is 1.2 trillion annually. And if you really do go higher for longer for another year, you're potentially 1.6 trillion a year from now. That's wiping out massive amounts of federal discretionary spending in the budget, and it's going to create a huge problem on Capitol Hill. So, but at the end of the day, I think that the reason why gold and Bitcoin have made this move is the beast in the market knows that higher for longer is a little bit of baloney, and the beast in the market knows that if they do go for higher for longer, they will very much just there'll be a Liz Truss moment, which is, we saw what happened in the United Kingdom when you have that irresponsible nature of spending relative to the bond market. And so that higher for longer mantra is I think over time, like every month that goes by, it's more and more obvious that promise isn't going to be able to keep the dollar higher anymore, because remember, higher for longer brings money into T-bills. It's so if you're a Saudi prince and the Fed saying higher for longer, you're going to take $1 billion and move it into T-bills and keep moving to treasuries. But once the market really gets the joke, and we know the Fed has to be on an easing cycle, that's where we're right about there right now. The dollar trajectory reverses pretty nasty in toward a softer dollar, and that's where we are right about now. Because if they do go for higher for longer, they blow up the consumer. And we already saw this with Starbucks and McDonald's. They blow up the bottom part of the consumer. They blow up the federal debt in terms of interest on the debt. It goes from 1.2 to 1.6 trillion. And so, they also, don't forget, they will blow up the super regional banks and that whole commercial real estate debacle. So all of that just tells you that the dollar and all this vocal cord activity around promising higher for longer to keep that dollar up, they're trying to suppress inflation with that strong dollar. The beast in the market knows and gets the joke. And so that's why we're on a much softer dollar path from this point forward.
But do you see, as some of our guests on the show have said, that they see the end of the dollar as the global reserve currency or the king of global reserve currencies in the next 15 years? Some have it as a 10-year outlook. Some have it as a 20-year outlook. Do you concur that things are that dire for the dollar?
Well, we saw with the UK how long these things take. I mean, it could take, it's on that path. It could take 30 years. But the most important thing for the investment thesis of our lifetimes, because, forget about 10, 20, 30 years in terms of the dollar demise. The dollar just on a trajectory where we've used sanctions against the developing world way too far, too aggressively. We've obviously taken capital away from Russia, which is basically, if you're an emerging market country and you're confiscating capital of Russia, even though it's with the best of intentions, because it's a nasty war, you're just incentivizing all these parties around the world to move away from dollars. And that's happening. And so the dollar as the percentage of trade, the dollar as the percentage of assets is going to shrink from your mid 60 handle percentages, which are extremes, over the next 10 years to more, maybe to the low 50s. And so you're still a reserve currency, but you're just in a much weaker spot, and people are going to own lots of other things besides treasury bills and treasury notes and treasury bonds and tech stock. They're going to own more hard assets. Like
gold. And we have seen central banks around the world buying gold at record rates. So let's get your outlook on gold now, because that's certainly what our viewers are always interested in. We had gold setting new record highs of above $2,400 an ounce. It's sort of settled into the 2,300 range. Do you have a gold outlook for 2024?
I think for 24, 25, I see 3,000 in the cards for sure. Near term, if you look at the GLD and the percentage of the GLD is above, which is a gold ETF, the percentage that the GLD is above the 200-day moving average is pretty crazy. And so I just think near term, you've had such a move that you're more likely to have a bit of a decline, but over, say, the next year and a half, 3,000, 3,500, I think it's a very high probability.
3,500 gold, high probability by mid 2025?
Yes, but remember, your better bet would be the commodity market's going to broaden out. So if you're at $3,500 gold, you're probably close to $50 to $55 silver. And so your upside from silver is a lot greater than gold.
That's exactly where I was going with this, Larry, because you are saying that silver is the place to be. You wrote in your latest report that the gold to silver ratio is breaking out in favor of silver, which is a very bullish setup for silver. So elaborate on that for us, please.
Well, we know about this solar demand for silver. We know about all the industrial demand, but central banks and investors around the world, the first thing they do is move into the mothership. They move into gold, but the higher the gold price goes, the cheaper the cheaper, the more attractive silver gets on a price basis. So historically, these types of big moves in gold bring lots of global retail investors into silver. And so that's one of the first things that happens, and we think that's about to happen. The next part of it is once the market knows that the Fed is committed toward an official easing cycle, that's where the money really starts to move into silver. And so in other words, if you look at 2016, where the Fed made a really big shift, even though we hiked that year, they were promising 7 or 8. They were pricing, like in 2015, 16, they were promising like 8 rate hikes, and they hiked once. And they made this huge shift in the silver miners and the silver itself dramatically outperformed gold in that kind of regime. It's the same thing historically in the 70s and 80s. So once the Fed makes a strategic shift in where all the Fed governors are in unison talking about a softer path, that's where silver dramatically will outperform gold. And that's where this gold-silver ratio is like an 84, 85 handle. It should be in a normal, mature commodity bull market. It should be in the 60s to maybe mid-50s.
So what does that mean in terms of price for silver? We had silver approach $30 an ounce in April, back down to the $27 range. Keeping in mind that, gold has hit new record highs this year several times. Silver is still very far off from its own all-time highs. Where do you see silver going price-wise by the end of 2024?
Well, I think by the end of 24, you got a good shot at 30, 32, breakout. We had this big drawdown within the last month or so. We look back at the bear traps report. We look back the last, 20, 30 years. And at the beginning of these great bull runs in silver, you typically have these beautiful candle tops, many of them. In other words, it's the sign of kind of like a lot of hot money. As the commodity market broadens out, the hot money the capital moves from gold and other commodities into silver. And you get these kind of bursts up, spectacular drawdowns, and then higher highs. And so that's I think, and then we saw this like in early 2010. There's that late 2010, early 2011, and so we think we're in that kind of like 2010, late 2010 environment where silver has a long way to go on the upside.
Do you have a price target then?
Well, I mean, I think within say between now and 2025, 26. $40 to $50 is on the table for us. I mean, just the supply of silver relative to gold globally, and just the cheapness as a percentage of in terms of the amount of global wealth that's in maybe $16 trillion in gold, right? Silver is a fraction of that, and so all it takes is $1 trillion to go from gold into silver, and you've got this. There's your move from $10 to $40 pretty fast.
And Larry, what is the best way for investors to get exposure to that silver uptrend that you're forecasting?
Well, the most conservative way would be like the SLV. And then I think at the early stage of a bull market, you want to move into the juniors. So your SILJ, which is your junior miners in the silver space. Your Pan American, your PAS, your Heclas, those are your more speculative plays. And then your SIL is a little bit larger silver companies. So more conservative way to play it is through the ETFs for sure. And then, if you're a professional investor, you look at silver futures in the futures market. Or, you look at funds like Greenlight Capital and let David Einhorn, buy the commodities for you.
All right, so you're very long silver, you're also long gold, but I want to bring it back to what you said at the top, and that is platinum, because in your latest report you wrote, take down your GLD gold long exposure and buy platinum. Tell us why you're so confident that the platinum versus gold trade is where to go.
Well, that ratio, the gold, this is the classic people moving into the mothership. All the central bankers have piled into gold because that term premium on treasuries, all term premium means is that when people trust longer dated treasuries less when the United States becomes just a tiny, tiny bit like an emerging market country in terms of people are looking at what's happening in Washington and they trust Washington just a little bit less. That a term premium expansion, which we've seen, term premium will move money into the metals, and so that's what kicks it off, and so the platinum space is so small relative to gold. We're talking about an Olympic-sized swimming pool. That's the equivalent of all the gold that's ever been mined in the world. Platinum, you can stand in that pool only up to your ankles, as I mentioned before. But also, the last 18 to 24 months, we saw this big, huge, high-profile sales pitch about electric vehicles. And what's starting to happen now is the repair costs on electric vehicles, the operational costs, the reality of owning an electric vehicle versus a hybrid, that's now becoming much more, well, the awareness around that pain for the consumer is much higher now, extremely. So like an explosion of hybrid awareness relative to electric vehicles. That's why we're seeing the performance of Tesla has suffered. And so what that means is if that whole life cycle, that rush into electric vehicles, if that is delayed by 10 years into a move into hybrids, and we're seeing this in some of the Japanese car makers, that means that your catalytic converters and your true, like you said before, your industrial demand for platinum and palladium is going to be around a lot longer. As the market kind of picks up on this trend, your upside for platinum and palladium is spectacular, and your gold versus platinum ratio is at a screaming buy platinum, sell gold range right now. It's the most stretch we've ever seen in the history of the relationship.
But that's a near-term play, Larry, right? As you're saying, we are seeing some disenchantment with electric vehicles and more hybrid vehicles and bringing in more industrial uses for platinum. But then, a big picture, one of the cases that you make for silver and copper is this whole decarbonization trend. So how does, platinum fit into that thesis a couple of years down the line then?
Yeah, that is a problem for platinum. And people say, hydrogen. In the case of aluminum will truly be a cost replacement for copper. And so that's where your bull case for Alcoa is pretty interesting. But you're right, that whole EV risk of if electric vehicle demand truly explodes and hybrids fall by the wayside, that's a big problem in terms of catalytic convert demand. So eventually things like green hydrogen and other technologies are going to come on, and that's your platinum demand. Platinum's a very heat resistant metal. So that's why with catalytic converters, there's such a tremendous demand for platinum and palladium. And with green hydrogen, if you think of like Caterpillar, you think of like all of these enormous pieces of equipment globally that are run on diesel fuel. You think about 20 years from now, 10 years from now, those being potentially hydrogen-powered vehicles or big, huge earth-moving machines that move from diesel to hydrogen, or big buses. This is going to create a whole new demand set for platinum and palladium that will be factored in over the long haul.
So given all of this and given the thesis that you've laid out for us, Larry, how should a portfolio be structured now in terms of percentage allocations? What are you looking at and for which timeline?
Well, one of the things we talk about in the book, When Markets Speak, is that your 60-40 portfolio of traditional stocks versus bonds is basically dead. And so that's a 2010 to 2020 deflationary regime portfolio. Now we're in a 40-40-20 portfolio where you want to be 40% stocks, 40% bonds, 20% commodities. Within that commodity bucket, you want to be right at this stage, you want to be pretty heavy in what we call precious metals and PGMs. And as the cutting cycle starts to take hold, and where we kind of go into an economic slowdown and then start to come out, then you want to start to be really over allocating toward oil, gas, and copper, and that's where you're going to get the real economic upside. In terms of like your S&P 500, remember 1980, the last commodity bull market with a multipolar world, 49% of the S&P was in industrials, oil and gas, and materials. 49%. Today, that's close to 12, 13, maybe 14% in the last 6 months. So we see that growing from say 13 to 14% up to 30%. So we're going to see within the next 5 or 10 years, your BHPs, your Rio Tintos, your Valets are going to be a much larger percentage of the market. You know, your Chevrons, your Exxons, your Hesses, your Marathon Petroleums. So you're looking for those parts of the market that part of the market will probably at least double in terms of its composition component of the S&P 500. That's in industrials, oil and gas, metals, and materials.
All right, Larry, I always like to put this out there as a thought exercise as we wrap up here. Is there anything that happens that derails your thesis?
Well, if there was another deflationary COVID debacle, like a nasty medical crisis globally that would force people once again to stay at home because of the pandemic, which would create a pretty substantial deflationary shock. That's one thing that would derail the thesis, at least near term. But the response to that would be, once again, a colossal fiscal and monetary response, which eventually would kick you into another inflationary regime. So you'd have a very large drawdown in this thesis and then a spectacular run-up. A Lehman-type crisis that was brought on by a large financial institution that was not contained by central banks, that would create, once again, a pretty nasty inflationary shock. Then you get this, remember, the Lehman response was $4 trillion fiscal and monetary. The COVID Silicon Valley Bank response was $16 trillion fiscal and monetary. And anything else coming down the trail is probably going to be bigger than that $16 trillion. And so therefore, you're going to have a big commodity bull market on the back end of that after a deflationary shock.
Okay, so basically it all leads to the same place, just extends the timeline a bit before we get there. Final thoughts, Larry, as we wrap up here.
I just say, there's no I in team, and I'm just blessed over the last decade. I did 140 speeches in 16 countries. After the first book, it was a New York Times bestseller, and I met an incredible nucleus of confidants and advisors. We run a conversation with them daily on the Bloomberg terminal. And so our business is mainly 80% facing institutional investors. And what I wanted to do with this book, When Markets Speak, is really democratize information and bring that kind of higher level of financial intelligence out to a broader group of people. And you can get everything in life that you want if you just help enough other people get what they want.
All right, that's a good nugget of wisdom to end on, a nice pearl of wisdom and good advice for life in general. Larry, really enjoyed reading the book and look forward to having you back on with us. Larry McDonald, thank you.
Thank you, Michelle.
And thank you, as always, to our viewers for watching. Remember, if you're watching us on YouTube, make sure to subscribe. Also, I love reading your comments, so feel free to drop those in as well. And I look forward to seeing you next time. From me and the rest of the team, we'll see you soon.